My neighbor Karen, she's 42, works as a project manager at a software company, texted me last Tuesday at 11:47 p.m. with a screenshot of her brokerage account, down 31% in 6 months. "Everyone at work is selling," she wrote. "Should I get out before it gets worse?" I stared at that text for a solid minute. Because Karen had just described the exact moment when 97% of investors destroy their wealth. And the 3% who get rich? They do the opposite. Look, I spent 7 years being part of that 97%. I bought high when everyone was optimistic. I sold low when everyone panicked. I lost $23,000 following what felt like common sense. Here's what nobody tells you about contrarian investing. It's not about being different for the sake of being different. It's about understanding that markets are just collective human emotions with price tags attached. And human emotions follow predictable patterns. Think about the last time you saw a "everything must go" sale at a store closing down. Did you think, "This is probably overpriced"? No. You thought, "This might be my only chance." But when stocks go on sale during a market crash, suddenly everyone thinks they're overpriced. Wild, right? Let me tell you about my friend Marcus. He's a firefighter in Phoenix, makes about $54,000 a year. In March 2020, when the market dropped 34% and everyone was losing their minds, Marcus did something that seemed completely insane. He borrowed $8,000 from his credit union and bought stocks. His coworkers thought he'd lost his mind. His wife didn't speak to him for 3 days. The financial news was calling it the worst crash since 1929. But Marcus understood something that 97% of people miss. When everyone is selling, that's when things get cheap. Fast forward 4 years. That $8,000 is worth 19 times $200. A 140% return while most people were sitting in cash earning 0.5%. Now here's where it gets interesting. Marcus isn't some genius analyst. He doesn't read earnings reports or calculate price-to-earnings ratios. He just follows one simple rule. When his barber starts giving him stock tips, he sells. When his barber stops talking about stocks altogether, he buys. That's contrarian investing in its purest form. But why does this work? Because markets aren't driven by logic. They're driven by two primal emotions: fear and greed. And these emotions create predictable cycles. When everyone's greedy, prices get stupid high. When everyone's scared, prices get stupid low. The 3% who consistently profit aren't smarter. They're just willing to feel uncomfortable. They buy when their stomach is telling them to run. They sell when their brain is screaming, "Buy more." I learned this the hard way in 2008. I was 29, had about $12,000 in a 401k, and watched it drop to $7,800 in 6 months. The guy in the cubicle next to me, his name was Steve, he switched everything to bonds. "I can't take this anymore," he said. "I'm losing money every day." I followed Steve's lead, moved everything to safe investments at the exact bottom. Steve retired last year. He's 61 and still working part-time because his portfolio never recovered. Meanwhile, the people who stayed in stocks during that crash, they doubled their money by 2013. That's when I realized something that changed everything for me. The crowd isn't just wrong about timing. The crowd is wrong about what safety actually means. They think safety is avoiding short-term losses, but real safety is avoiding long-term poverty. Here's the framework that finally clicked for me. I call it the 3% rule, and it's stupidly simple. Every time you hear the same opinion from 3 different sources in the same week, bet against it. If your Uber driver, your dentist, and your brother-in-law all say the same thing about the market, do the opposite. When everyone says buy, you sell. When everyone says sell, you buy. But here's the part that makes most people uncomfortable. Being contrarian means being wrong in the short term. Marcus was down 40% for 2 months before his strategy paid off. I was wrong for 8 months when I started buying during the 2022 bear market. The crowd will make you feel stupid. They'll tell you you're gambling, that you're crazy, that you don't understand what's happening. And that's exactly how you know you're on the right track. Think about every major wealth-building opportunity in the last 50 years. Amazon in 2001 after the dot-com crash, real estate in 2010, Bitcoin in 2018. In every case, the crowd said it was too risky, too late, too uncertain. The 3% who got rich weren't the ones with the best analysis. They were the ones willing to feel uncomfortable while everyone else played it safe. Now, if you're someone who finds yourself always buying after good news and selling after bad news, if you're tired of watching other people profit from the same opportunities that scared you away, this approach isn't just about making money. It's about rewiring your brain to see opportunity where others see danger. Tonight, before you check your portfolio, ask yourself one question. Am I making this decision because of logic or because of what everyone around me is doing? That question alone will put you ahead of 97% of investors.